Okay, so the next company on this list is Google. Now, Google made a big announcement that they would reduce the cost to buy an individual share of their stock at some point this year. They announced a 20-to-1 stock split, so if you own one share, it's going to be broken into 20 shares. It's sort of like if you held a $20 bill and somebody split it into $21 bills. Now, there's been a few big stock splits that I've watched closely over the past couple of years. For example, when Apple and Tesla both split their stock in 2020, the stock saw a really huge rally before the eventual split. Then they both experienced a little bit of a slump before returning to higher highs. Now, Nvidia also announced a stock split last summer, and the stock also had an incredible run between the announcement before the actual stock split actually took place. Now, there's definitely some differences between Nvidia, Tesla, and Apple when they did their stock splits. The market was a lot more bullish in 2020 with the meme stocks and the small cap stocks hitting new highs, and I also think that Apple and Tesla were priced a little high, but relatively fair valued at the time. When Nvidia split, we saw the run up which occurred when the market was still extremely bullish, but post-split is about when the market became more neutral, at least as far as meme stocks and the small cap stocks, which I think was the same type of investor who was buying up these stocks during the split. Now, Nvidia did see a continued run post-split, but the stock did sell off, and since then has returned to its price around the split. I think the issue for Nvidia was the stock was really just too expensive in the post-split surge, and in November, I actually made a video about how I sold my Nvidia shares because I thought the stock was too expensive, even though I liked the business. I definitely took a pretty good amount of thumbs downs, but it does look like that I sold near the top. So I think what we need to consider for Google is this. Is the current valuation low enough to support a massive run-up without becoming overly expensive? And will there be enough momentum to drive a run-up of the share price? So let's take a look at the valuation first. So Google reported its earnings on February 1st, and they reported earnings of $30.69 versus $27.34 expected. They also reported revenue of $75.33 billion versus $72.17 expected. Google also saw one of their biggest winners, advertising revenue, at $61 billion, which is up 33% from the $46.2 billion they earned in the same quarter last year. So when we look at this quarter compared to the rest of their earnings, Google has continued as the growth machine that we've seen in the past. That $30 per share in red looks like a very solid quarter and seems like the continuation of the previous trend. Now, when we look at the last 10 years of revenue and profits, we can see pretty much the same growth trend reflected in the earnings per share growth. What's incredible to me is that even at $182 billion in revenue in 2020, Google was able to grow by almost 30% for the full year earnings and almost doubled their profits, going from $40 billion in 2020 to $76 billion in 2021. When we look at Google's revenue versus expenses, their cost of revenue is just under half of the revenue, which gives them the ability to have such high profit margins. Google spent $31 billion on research and development, which you can see in blue on this chart, and it hardly looks like anything. So when we break down their segments, I was surprised to see the Google Cloud segment actually doesn't produce any profit. Google actually loses between $3 to $5 billion on that segment a year, while it only brings in about $9 to $19 billion in revenue. Now, the real star of the show is Google Services business, which is made up mostly of their ads business. It brings in all of their profits and almost all of their revenue. Over the past year, Google Services brought in $237 billion in revenue and $91 billion in operating profits, which is a really insane number. When we look at their forecasted earnings, Google is expected to continue growing from $257 billion in revenue and $76 billion in profits to $398 billion in revenue and $101 billion in profit by 2024. When we look at the forecasted growth for Google, the current expectation is for them to slow down between 14 to 17% over the next couple of years. At that growth rate, that would put Google's fair value between 31 for the bottom end of the range and 41 for the top end of the range. However, when we go over to macro trends, we can see that Google typically trades towards the lower end of this range, around 30 to 25. So if we use my fair PE values between 31 and 41, that puts Google at an extremely cheap valuation, with the stock currently worth about $3,400 to $4,600 based off the current earnings per share, and a 2024 upside of $4,700 all the way up to $2,686 by 2024. Even if we use a more conservative valuation with the PE ratios the stock has recently traded around, we can see that still puts Google around the bottom end of its current fair value range. By 2024, this puts their upside around $3,800 or 33% higher than today's share price, and a top end of the range around $4,600 or 60% higher than today's share price. So Google is definitely a buy right now. I think it's very possible that as we get closer to the stock split happening, that a lot of people for whatever reason are going to buy up the stock just to see their shares that they own go from 1 share to 20 shares. Again, stock splits really don't change the value of a stock, but what we can definitely see from this valuation is Google is absolutely undervalued right now. Now, that video that you just watched is part of a much larger video where I covered earnings for multiple stocks. So if you want to see that video, click this right here. And as always, thanks for watching.